Hi, this is Fred Oltarsh at the Libanman Trading Desk, coming today with the options strategies selling premium discussion. Thanks for joining us. Hope you enjoy the discussion and that we meet some points that are somewhat new to you. Some of the things we'll be covering today are following market trends to generate income, strict risk management to limit risk, using options analytics to establish positions with reasonable risks and rewards, and understanding the full risks of selling premium. Again, I'm Fred Oltarsh, the Senior Vice President here at Libanman Futures, and we're coming to you from Wall Street in New York City. Keep in mind the following analysis includes transactions for educational purposes only and does not include commissions or any extraneous factors like market illiquidity. Assumptions are made about market prices. Futures and commodities trading involves significant risk and is not suitable for every investor. There are many reasons why traders sell premium. Some of them include the following. Belief that options premiums are too high. I suppose if you're selling it, that's a pretty obvious one. You certainly must think that what you're getting paid for what you're selling is a little bit too high. Some think that the best way to take advantage of a directional bias is to sell premium, and in certain cases that may be true. They think that the income is an excellent supplement to their current position. Another thing that they're looking at is the belief that most X options expire worthless. Excuse me. And that's an interesting belief. There are many takes on that. While every put has a corresponding call, that means that for every in-the-money option, there is an out-of-the-money option. And if that's the case, in terms of strikes, there are as many worthless options as are ones that are in the money. When we talk about open interest, it may be true that the most open interest expires worthless. But that doesn't mean that the ones that are expiring with value aren't with a lot more money to make up for the ones that have expired worthless. Lastly is the point that people who trade options hedge them with futures contracts. So even if you were to sell an option, if your hedge wasn't good, you could lose money on that portion of it. So it's a rather simple way of looking at it that most options expire worthless. And then the last thing some people say is people make a lot of money selling options. I guess that's true. Some people do. But we have to worry about you and whether you do and whether you're maintaining the risks properly or not. Understanding implied volatility and the option skew is crucial to understanding options valuation, and so we want to make sure you understand that the implied volatility refers to a mathematical percentage for the value of an option. It was made famous by the Black-Scholes model. The relative value of each option can be compared directly by the implied volatility. The model indicates that the implied volatility of each option should be the same. So in gold, if you had a $1,300 call, the volatility on the $1,300 call should be the same as the $1,350 call. So it isn't the case, but according to the Black-Scholes model, the at-the-monies and even the $1,500 call should have the same implied volatility. The skew refers to the slope of the implied volatility in the option series. So in the example I just gave, if the 1,300 call was 21 volatility, and the 1,500 call was 26 volatility, the skew would show the difference between strikes as you go further and further out of the money. These are very important things for people who are trading options to understand. If you don't understand them, you should review them. You should make sure you understand them. And if you don't feel comfortable with the thoughts, you should give me a call, because I'm happy to go over it with you and discuss how important these aspects of trading options really are. Here's an example of the coffee market. The chart below shows a skew in coffee, which had an implied volatility of at the money in the mid-30% range and a significance call skew. Now this was a while ago, so this example is clearly out of date. But here it says the December 177.50 call has a volatility of 36.80. The out of the money calls, the 237.5 call, has a 42.39 volatility. So here's an example of the at-the-money implied volatility and the skew as it goes further and further out of the money. On the put sides, it actually gets cheaper until we get to about here, and then the implied volatility goes up. Looking at the skew and the absolute value for the implied volatility and analyzing that is very important. So here's what we're going to look at. We look at historical volatility, we're looking at implied volatility, and then we're looking at a host of information that can help lead you to what your strong market bias is. People look at a relative strength index, they look at the average trading range, they look at the charts, they look at all those things to help them have an opinion about whether they want to look closely at a market and then compare the historical volatility to the implied volatility, and again looking at the skew. Daily information to consider before trading would include the following. We look at the symbol, the last price, the net change on the day. I look at the percentage change to get an idea of just how big a magnitude it is, the range of the day, and the dollar value range, and how that compares to the volatility in the past 20 days. Here's the 20-day average trading range and the 20-day average trading range dollar value. Give you the relative strength and also gives you a moving average. How does the current price compare to the moving average? There's both a 21-day and a 60-day moving average. This information is provided every day on the web at Libanman.com with an article that I usually write along with it. So you have an opportunity to review what I would consider vital information about every market, and you can do it on our website. We also publish that article on InsideFutures.com. Now, if you look at the open interest, the volume, here come some important numbers. The 10, the 30, and the 60-day historical volatility. The change in volatility. The average implied volatility. Now, if you look at it, this is clearly a mistake in data. The volatility did not go down 34.60, and probably had to do with the settlement price, which was limit down here in cotton. Thereby, the implied volatilities were miscalculated in the system. But in any event, the average implied volatility is trading at 47.55 here, 44.83 in coffee. We go down and we see the grains, and each of these markets is reviewed on a daily basis. Tells you the skew. So once you start looking at this, you might say, well, do I want to sell a particular option? Well, in coffee, the implied volatility is 6 vols over the 30-day historical volatility. So if you look at them, sugar is even higher. Now, that doesn't mean that they're automatically a sale. But if you combine that with your market bias and you look at a chart and you get a pinpoint where you think the market should be and where you think it probably won't go, it may help you define your area of putting in your price and establishing a position. For example, in this coffee chart, which is a weekly continuation and is rather old, it looks like we have support around 150. We're trading 175 area, with support around 150. One might consider doing some trades that might benefit in this area if you wanted to sell puts. Now, because the nature of the puts is getting cheaper and cheaper, we might want to sell a higher price put and buy a lower price put as a put spread where we think we're getting good value. There are a number of things we may want to look at. We may want to say, I think that because of the skew on the upside, I don't really think coffee is going very much higher, although it did. But you could sell the 220, 250 call spread for a credit, and that might be something that you'll consider. So there are a lot of different opportunities to use the skew and the implied and historical volatilities to get a sense of what type of transaction you might want to make. An example of selling a call in crude oil shows you the risk rewards of the transaction. In this case, you're going to sell the 77 call for $3,000. It makes you good anywhere below 80, you're going to make a profit. Anywhere above 80, you're going to have unlimited losses. That's the nature of selling naked calls. You want to understand the delta of the transaction. You want to understand your exposure. And you probably want to set up where you're going to get out if you're wrong. On the put side, you're going to sell an 80 put for $3,000. Makes your break-even point 77. Anywhere below that, and you're going to be taking delivery because you sold a put, you're going to lose money below 77. Anywhere above 77, you're going to be a winner. You're going to make the $3,000 you collected, but here your losses are protected, could be unlimited. So we got to remember this. We're going to look for a trend, and we're going to have a market opinion. We're going to look at the implied versus the historical volatility. We're going to look at the skew in the market. So we're going to see how this skew can give us a certain advantage in establishing our position. We're looking at different strategies. We're not going to just sell calls just because that's what we want to do, or sell puts. We're going to look at things that are a little more complicated that may help us over time. Ratio spreads, calendar spreads, direct vertical spreads, things like that. Those type of trades where we can take advantage of our market bias, and we can also understand how the implied versus historical volatility might be our advantage, and the skew could give us an extra advantage as well. We're going to look at the delta of the transaction. We're going to understand that that delta is only good for now. If we sell an at-the-money call with a delta of a half and we rally, we no longer are short a half a delta on that contract. We're short more. So we've got to keep an eye on that. We have to understand what we're going to do, and we have to be willing to take a loss if necessary. Lastly, how much are the commission costs and slippage dealt with as part of a percentage of revenue? You don't want to sell a $100 option if you know that your commissions are going to be $25 or $50. It doesn't make any sense. You want to make sure the risk rewards of the transaction are good, and that's something we want to focus on. I hope you enjoyed discussing some of these items in the Selling Premium webinar. Selling options involves tremendous discipline. The reward can be significant, but strict risk management is required. You can go to our website at www.libanman.com to see our full services, open an account, or find additional educational videos. You can also call me directly at 212-383-9453 to make my background and experience a part of your trading. I look forward to hearing from you. Thanks for participating in today's discussion.